Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today on our EIA show, we're going to break things down into our three different segments. And in the first segment, we want to talk about how Russian flows are changing and how that's really impacting some different pieces. Because when you look at it in general, you're seeing flows go to the Middle East, Asia, but how is that adjusting the US? So how is that impacting our top line numbers if we want to build out that case? In the next segment, we're going to look at how how winter is going to change distillate demand, because when you look at the rest of the US, things are fairly normal outside of the East Coast. We want to break that down a bit. And then in the last segment, we're going to look at OPEC and how OPEC has taken down some of their demand estimates, but you're also seeing West African sales slow, which is exactly what we called for, is that West Africa was going to struggle to sell. And now there was just a headline that came out that said OPEC exports may fall 1 million barrels a day in November. And it's going to be important to see, well, why is that happening? Because again, there's a lot of storage in offshore storage in the Middle East, and we want to look at how those dynamics are changing. So now getting right to what is happening in Russia. So as we get closer towards the cap, which is supposed to start in December, right now everybody seems to be on board. We still don't know a price. We still don't know a lot of things. But ahead of that, Russia is pushing out as much product as possible. And it's not surprising to see that there's a lot of demand that continues to flow into Asia, with China being the biggest one, as well as India. So now when we start looking at the UAE and in the Middle East is actually increasing their purchases of product, which is what we had said was going to happen a couple of weeks ago. And we saw it start over the summer, and it's now just accelerated where the Middle East is essentially importing their refined products and crude, if they can, commingling it in a tank, and then selling that under their flag. They could also take this discounted product, run that through their domestic demand, and then take the product they create and slate all of that for export. And these are a lot of things and adjustments that are happening. So here we have a quote, Moscow may have found an important new outlet in the UAE for some of its crude shunned by traditional buyers in Europe. 700,000 barrels of Russian crude showed up at Abu Dhabi's refiner earlier this month after hauling it from the Arctic export terminal. The EU has imposed sanctions on seaborne imports of Russian oil that will kick in on December 5th. On the same day, the EU and UK are set to prohibit their companies from providing shipping, financing, and insurance for tankers carrying Russian oil unless the shipments are priced below a cap. But again, you can price it below a cap and then have a sweetener on top of it. There's a lot of ways around it, especially for those that have gone through the rules and regulations. I mean, it wouldn't be very difficult to usurp some of these things, but we'll talk about it because as it gets a bit clearer, because we still don't know what the cap looks like. We still don't know how that's going to be, in terms of price. We don't really know much about it, and that's something that we're going to want to look at to see how are there ways around it, and running it through a friendly country to both sides, or at least an agnostic country to both sides, would be one way to do it. Now, when you start looking at underlying flows, more Russian fuels coming to the Middle East and Asia. And that's something that is, when you look at the percentages, so the percentage of Russian fuel exports headed east has continued to grow. And it's not surprising to see the amount increase post-February. And that's something that is going to remain elevated, especially when you look at how much of it is going to in 2022 versus 2021. So it's not just the UAE. And I think that's the most important piece. UAE, Egypt, China, Singapore. But look at Saudi Arabia. Saudi Arabia was the one that was doing this over the summer. They were importing heavy fuel oil from and other middle distillates from Russia, using that in their power burn and exporting their product into the Europe, or I should say just the Atlantic Basin in general. And then Malaysia is always the favorite place to switch flags, when that's where you get a lot of ship-to-ship transfers. That's where you get a lot of these different shifts. And that's going to be a very interesting one to watch, because that's where a lot of crude goes to change flags. So another good quote, well, while the flow of Russian fuels is set to pick up, there's a possibility Asia can't fully digest all the excess, contributing to lower prices and a rise in volume stored at sea, which we've already seen. And you're seeing the Middle East essentially play the arbitrage of taking in their Russian product and exporting fully their own and consuming Russian product within their own borders. Local markets for naphtha, high sulfur fuel oil are already oversupplied, in part due to the Russian products. But again, that's an opportunity for them to use that as feedstock into some of their refiners, especially if you have high sulfur fuel oil and other types of products. And then the time spreads have come down because of it, and the volume of Russian crude and oil products being stored at sea worldwide jumped from 5.6 million barrels as of September 11th, which up from 2.9 million barrels at the start of the year, according to Kepler. So again, moving things up in that direction. And here's one of the key things that is going to shift for us when you look at the U.S. Well, there's new and existing gas pipeline export capacity for Permian, Haynesville, and Appalachia. And a lot of that is, again, directed towards the LNG market. And given the fact that in the U.S., when we look at natural gas prices at about $5.89, when you look at LNG prices that are averaging about $30 or more, well, a lot of this product is going to make its way into the international market. And then when you look at the data on the gigawatt hours in Europe, you can see that things still remain fairly low on the natural gas consumption side, but this is only going into November, and there's naturally an increase in demand. So you want to see, how does that demand change? So October loadings of Russian diesel to the Middle East and Asia continue to rise ahead of tighter European Union. But again, that not going to Europe could come to Europe and the Atlantic Basin a different way. But even with all of these different things situated, there's still a lot of demand for new LNG capacity. German nationalized the second gas major of SEFE. And then Germany has also turned on an LNG, a regasification facility, again, to try to take in more of this gas to offset the fact that they're not going to get piped gas. They're going to have to rely more on the importing markets on the floating side. So there's a lot of key pieces that have to be watched, and it's going to support, again, more pipe in the U.S. and a lot of that being directed into the international markets. Now, when you look at total oil product stocks, here you can see that they flipped to a deficit from a positive from 3.8 million, positive 3.8 million to minus 16.6 million. So stockpiles in surplus versus seasonal average, stockpiles in deficit versus seasonal average. So when you look at things, remember, as we were talking about, the comps got easier. So as we progress through the end of the year, you can see that we're right in line with where we've been on the range, on the average of 2017 to 2019. We're right where we were in 2021. And when you look at total oil and stockpile and product stockpiles, we think it's going to hold flat here and really outperform where we were in 2021. And here's one of the key reasons why. When you look at total crude stocks, land and floating, the surplus still remains, but it's narrowed from 33.7 million to 8.5 million. And it's because we did get a drop in floating storage as we saw more of that crude get pulled into the market. And all of that was driven by Asia, aka China, as you started to get some of that, some of the refiners getting back to a bit more of a normal run rate in order to close out the gap. Because remember, there's those import quotas, so they're trying to take in what they have offshore and then free up more opportunity to purchase, so that as it shows up, because there's still a lot of crude that is directing its way to China, and they need to ensure that there's capacity to store that offshore. So there's some of that switching back and forth. But as it comes from floating, it's going to go into land, which again is going to help total oil stockpiles in total remain above or right at that seasonal norm. Because when you look at total oil product stockpiles, the deficit narrowed from 29.8 to 25.1, but there's still a deficit, and that's all driven by middle distillate. So the disconnect or what is driving that normalcy is really the amount of crude that is on sitting on both land and the floating side. So then when you look at land storage, the deficit widened from 35.1 to 36.5, but you're still well above where we were in 2021. And again, moving further up in terms of just at the low end of the cloud, and there's still some support to send us a bit higher. West of Suez, the deficit widened from 17.6 to 17.9, but there's still going to be some of this back and forth. It'll drop back down. We think it'll essentially split the difference between 2021 and what the normal range or average range is between 2015 and 2019. And then east of Suez is going to be an interesting one to watch because the deficit widened from 14.2 to 17.5. When you look at east of Suez, it's greatly going to outperform 2021. But the question is going to be how quickly does some of that product show up on the coast? And that's going to be the delta of some of the differences that we've seen. And here's why. Because when you look at floating storage, the surplus narrowed from 22.2 to 9.1. When you look at west of Suez, the deficit widened from 0.2 to 0.4, but it's still moving closer to the higher end, and a lot of that is being driven by West Africa, which is seeing a bigger increase again of floating storage. And then east of Suez, the surplus narrowed from 27.6 to 11.1. But that's all being driven by Asia because the Middle East has actually seen an increase, a counter-seasonal increase of floating storage, which is going to be interesting to see when do some of those discounts get rolled through to try to clear some of the glut, which we're going to talk about more in segment 3. Now, when you look at crude oil, crude stocks in the U.S., there was a draw of 5.4 million. Here you can see that the draw was really driven by Pad 2 and Pad 3. Pad 2 had a drop of 2.87 million. Cushing had a drop of 1.62 million. Pad 3, Gulf Coast, had a drop of 2.36 million. Now, when you look at this all together, so Pad 3 still has more than enough crude, still very elevated for this time of year, especially as you start to look at when are taxes going to have to be paid. That's when Texas starts to move things around a bit. But Pad 2 is going to be interesting because the TransCanada declared force majeure on the Keystone Pipeline, which was about 590,000 barrels a day to 610,000 barrels a day. They said it was weather related, so it'll be a hiccup, but that's going to be important because you're going to see shortages that are going to start to come into Pad 2 again, which is going to pull down some of this storage, and it's again going to make that 5-year average look a bit worse, even though on a year-over-year basis, you're fairly in line. So against the 5-year average, Pad 2 is 24.1 million below, Cushing's 20.7. But then as things get better and back to normal, you'll start to see those flows adjust. And just given on the demand side, you should start to see that show up in storage once again. The CPC oil terminal continues to move along normal lines. That's increasing, which is going to be better for Europe. And the additional capacity coming into Europe is actually diminishing some of their buying that has been happening from West Africa and the Middle East, which is why we're starting to see those gluts increase again. In the U.S., Pad 3, right around where we were in 2021. The only 2 years higher was 2016 and in 2020. So again, that's something that is fairly stable. You can see that there is a normal drop from this point on, and a lot of that is, again, driven based on the need to reduce exposure to taxation. So that's going to be an interesting play. So we should start to see some of those drops continue in the near term in general. Cushing had a little bit of a drop, but you can see here that we're still on an upward slope. You can see in general there's normally a little bit of a drop before we turn back up. The question on how quickly we could start to see some of those rise again is going to be specific to what is happening on the Keystone Pipeline and how long that is, the force majeure is in place. Because as the force majeure goes away, we should start to see the builds continue into Cushing. So that's going to be one to watch to see how quickly that happens. When you look at runs in the U.S., we're at 92.9%. There was a big increase in Pad 3 of 218,000 barrels a day. So again, you're still seeing those run rates run back up as these guys try to capture that great distillate crack and that distillate spread, which we're going to talk more about in segment 2. Here you can see the utilization rate in terms of historics. On the utilization side, we're continuing to be elevated. And again, we were coming out and coming back into a peak season, which is typically going to run you from the middle of November till about the middle of January, end of January, until you start to see things slow down. And then they hit their low in about February and then start to pick back up as we get into March. Then when you look at imports had a big drop of 894,000 barrels a day. It was sweeping. There were drops across the board. Pad 2 is going to continue to have that hit just because of the Keystone Pipeline. Once that is fixed or adjusted, that will come back up. Pad 3, it's that timing delay that we've been talking about. Still, that's a big drop of 257,000 barrels a day. Excuse me, that's 685,000 below normal, or below the 5-year. That's 359,000 below year on year. So again, there's still a lot of variability within what is coming into Pad 3, and we do see that remaining. Pad 5, something similar. Drop of 199,000 barrels. We do see an increase in imports in both Pad 3 and Pad 5 just based on what the boats are showing. But you also have to consider day rates are very elevated right now, and it's making it harder to support some of these flows, which is going to be an interesting one to watch as we go through the remainder of this year, which is here. You can see that Pad 3 imports. Now, seasonally speaking, you can see that there's been drops at this point previously. We do see a recovery, but not a big one, just back to where we were essentially 2 weeks ago. And again, a lot of that is going to be the timing, but we do need that heavier crude to maintain a fairly elevated distillate cut. Imports into Pad 2 had a big drop. A lot of that is, some of that was just because of the natural movements, but then when you factor in Keystone, that's going to keep those imports depressed. So we're now going to go from what we were assuming to be above the 5-year average, in the top end of that cloud. We're now going to be below the 5-year average and bumping closer to the bottom until that force majeure is lifted. Implied demand has come down. We had a drop in gasoline demand of 269,000 barrels. If you look at Gas Buddy, they actually had a bigger drop. So, and this is what we've tried to explain when you're looking at gasoline demand and gasoline flows. There's always going to be a certain amount of seasonality. There's always going to be reporting, and now you're going to see some of the makeup between where things were previously, where things are now. But that's still, we have us at about 8.5, 8.6 million barrels a day. Gas Buddy's at about 8.3. Here you can see that EIA is at about 8.7. So it's just a mixture of, it's fungible as well, because where are you calculating? And then obviously there is a certain amount of calculation, an algorithm that comes in. So they're all estimates, but usually over the course of 4 weeks, you get an idea of where things are flowing. Distillate had a drop of 298,000 barrels, at 3.86 on the low end. But again, trucking continues to be terrible. And we're going to talk more about that in segment 2, which is going to be a headwind for distillate demand, even as you get an increase of the heating demand side. Jet had a little bit of an increase, but think about where we are. We're coming into Thanksgiving. Thanksgiving is next week. What is that going to mean for demand? And you're going to be surprised to know that it goes up. So typically this week, you're going to see an increase in flows on the jet fuel side, on the gasoline side, as these companies make sure that all of the assets, from the gasoline side all the way down to the airports, have the fuel that they need to meet the spike in demand, because Thanksgiving is typically one of, if not the largest travel holiday outside of obviously 4th of July weekend. So that's why there's not surprise there in terms of flows. Propane had a drop of 262,000 barrels a day. Below the 5-year average. Local demand is going to continue to struggle, especially when you look at the factors in terms of petrochemical demand. U.S. gasoline implied demand, you can see it's right at the low end. It's at the lowest it's been since 2020. We just think it, again, just hangs in right around these levels. Typically, you're going to get a spike. We normally get spikes this week, and especially because when you look at things going forward, You have Thanksgiving coming up. You have to make sure everybody's supplied. When you look at crude oil, we're right at where we were in 2021. We still expect crude oil inventories to be fairly flat, not too much of a change in general. But it's going to be important when you factor in the SPR, because when you look at draws, we had a draw of 5.4 million barrels. Then when you factor in the SPR, we had a draw of 9.5. So you had an additional 4 million barrels coming out from the SPR. And that is going into a mixture of the export market, as well as going in and supplementing some of the flows and some of the storage that is in Pad 3. When you look at days of supply, fairly normal, not much to say here. When you look at total storage, looking at crude and products, it's going to stay flat. The biggest overhang remains distillate. We see gasoline builds increasing, while we'll see pretty stable moves on the crude front, but realistically distillate is going to be that shift. Here you can see the pivot higher on the gasoline front. And this is typically you have one more drop again as we get product moving into position for Thanksgiving. And then you can see that seasonally speaking, we're just going to have a normal move up. The question is going to be rate of change. You can see that the rate of change here is bigger than what is normal for the 29-year average. But when you break it down into its different pieces, you can see that the rate of change is fairly normal at this point in time. Distillate continues to be well below normal. And again, all of that is being driven by Pad 1, which we'll talk about more in the next segment. Here, when you look at jet is moving back up on the storage side. Some of that is going to flow into the airports, and some of it is going to be, again, they're going to try to keep this low to maximize what is in the distillate pool. When you look at the crude futures, again, a lot of softness remains in the front month, but we still see firming in the back months. There's still some of that demand that's going to come through at the beginning of next year. When you get a renewal of import quotas for China, you get a certain amount of scheduled reopenings that are supposed to happen. We still think that there is a massive overhang in China, but things will get better enough just as you're getting additional drop downs from OPEC. So supply is going to come down a bit. You're going to have a little bit more demand into Asia. And none of that is going to be this like, oh, we're going to go to 200,000 barrels a day. But there's going to be enough support to kind of keep us where we are, and some of that stability when you look at some of those underlying flows. And then when you look at floating storage in the U.S., we're fairly elevated versus where we've been in the past. And a lot of this is because we had a drop of imports. Some of that got put into floating storage. That will flip, and then you'll typically see that timing delay play out, which is why we will see imports pick back up into Pad 3 and this get drawn down a bit. So that's what we have for you on segment 1. In segment 2, we're going to go deeper into the U.S. and some of the flows that are happening during this time period.